Let's get a fundamental take with some global touch as well. William De Winter, who is the CIO at BNP Paribas, joins us on the show. William, hi, morning. In the US, the victory party is over. Now Obama and investors are all facing the cliff. Do you expect a last-minute fix to this? How do you see markets reacting during that period? Could investors panic if there is any delay?
Well, I think as long as we do not have let's say, overwhelming clarity of going in either or the other direction, the uncertainty just will continue. That is what we have already been seeing since mid-September, actually. When you look at how the S&P has evolved, it peaked the day after the FOMC announced its new policy guidance in QE3, and since then it has been gently trending down. This is an expression of uncertainty related to the cliff. Of course, I think one has to assume that a sensible outcome will be found. We don't know when. And I think the only thing investors can do is to take inspiration from the market behavior last year in the month of July, when there was a hot debate on lifting the debt ceiling. At that time, equities went down, treasuries went up, so a decline in bond yields, and gold also went up. And I think this is the type of setup that normally we should expect again, until we have clear evidence that the fiscal cliff is going to be avoided.
William, so do you expect the risk-on rally to continue, or you would advise investors now to sell risk and buy safety, which is sell equities and shift that money into bonds?
Well, for the time being, the dominating theme is related to what's happening in the US and the budget discussion. That is an environment which makes it impossible to have a lasting risk-on rally. You can have some up days if you would have some good economic data, also news coming out of Washington that perhaps the meeting went a bit better and so on. But you really need clear evidence that one is going in the right direction and that the deal will be struck well before the deadline. And we just do not have any, I think, clue about when a deal would be struck and likely, because you can do all sorts of analyses how the different parties will behave. So, in a nutshell, risk on, I don't see it happening. I do not see where the other positive catalysts would come from, and I do not think that some positive economic data surprises would be sufficient a condition to have a lasting risk-on rally.
So, William, now that you're claiming that there is going to be no year-end rally, what about 2013? Will that be a year of equities?
Yeah, well, I've looked at my crystal ball this morning, but it was rather opaque. I think the real issue that we have is that we continue to be in a structural environment which is not really kind to equities, and that is characterized by deleveraging, hesitation to build up more debt with these household companies that could afford to do that, and so on. So we think that 2013 will be more characterized by a succession of risk-on, risk-off waves again, a bit like we have seen this year. I think actually that 2013 may seem like less tense at the start of it. We had huge question marks at the start of 2012. Let's keep that in mind. 2013 may seem less tense, a bit better under control, especially if we have a deal on the fiscal cliff. But we should not forget that the jury is still out on how effective monetary policy is. Will we see a lasting acceleration in growth? At the same time, if there is lasting acceleration, meaning higher than the levels that we have been seeing as of late, it should not be too quick, because otherwise people would start to be scared about the Fed being too much behind the curve.
Now, William, India has seen some reform steps being taken recently. Can these be game changers, or a lot more needs to be done for foreign investors' view to change for India?
I continue to be of the view that structurally the potential is huge, but you need to work on the supply side. I think the frustration one can have in looking at India, certainly as a foreign investor, is that you have a kind of a supply bottleneck. Growth has been slowing, but inflation remains stubbornly high, although it has been coming off. So we really need to work on the supply side. So all these measures which have been announced should be welcomed, but you have to continue along that direction. This is something which is of fundamental importance, one both for the Indian population, but also for attracting continued foreign money into India, and thereby underpinning the currency, which would then pave the way for more monetary easing, but also keeping in mind that the foreign participation in the stock market is already very high. So if you want to move it up further, you really need to go beyond the purely cyclical catalysts like some easing there or whatever, and you need to go beyond that and work more on the structural side.
William, what about fiscal challenges? Because they clearly remain for India. Industrial production for the month of September has declined by nearly 0.5%. Inflation was high. Can India surmount these problems? And do you expect easing by the central bank anytime soon?
Well, the easing is something, of course, which should have a positive impact. That is at least a textbook analysis on growth. However, you have to take some nuances there. One, you have to avoid, of course, that as a central bank you would suffer in terms of credibility. So if there would be a perception by foreign investors that the easing is inspired by, let's say, some pressure hints or whatever coming from the government, which I believe has been an issue, at least in the media in India in the recent past, that would be bad for credibility. Secondly, irrespective of that point, whether it was the case or not, I think there's the important element that you should not put in jeopardy your credibility by easing too much and thereby ignoring the inflation objective you have set for yourself. Because that would again weigh on the currency and kind of set in motion a negative spiral, a bit like we have seen in 2011. And then the other element is really on the supply side. I think the reaction of the corporate sector to an easing of interest rates, a priori would expect it would be positive, but on the other hand, corporate gearing is already high, and that means that there may be some reluctance to react to the interest rate easing.